Good morning, everybody. Just before we start, just let me know if my mic noise is a bit funny. I've got a fan on in the office because it's a bit hot. So if it's blown on the mic, let me know. Otherwise, we shall crack on. Morning, Kay, you all right?
Yeah, morning, Ryan. It's all good, by the way, your microphone. We don't hear too much of the fan noise. I've got mine on as well. Watching paint dry for the time being, but yeah, some stuff is moving at least.
Yeah, it seems quite a bit going on in the afternoons and quiet in the sort of European mornings, and then it all kicks off when the Yanks come to play. But, anyway, it gives us time to do the paperwork. Right, well, let's get stuck into it because there's quite a lot on the central bank front to get over and through today. BOJ's Nakagawa said it's appropriate to maintain easy monetary policy for the time being. Can't say that the price target is achieved yet. A further YCC tweak cannot be ruled out, but is not an imminent issue now. There's no preset idea on order or timing on how to phase out easy policy. So a bit of a script speaker there, staying on the issues. On the data front, we had some leading index numbers, latest leading index data out from there. If I can find it, down here somewhere. Leading index a little bit lower than expected, 107.6 versus 107.9 expected, down from the 108.8. As you can see, they're down 1.2%. We also had some foreign investments, bond buying, stocks numbers there. As you can see, a little bit less on the bond buying, or quite a bit less on the bond buying, and a complete flip around on the stocks buying. Anything to take from those numbers, Kay?
No, not really, mate. We know those bond and stocks. They're pretty variable and everything. No, I don't think we need to go too deep into those numbers. But yeah, the Nakagawa comment coming the session after the MOF and Canada going all a bit panicky on what's happening with the speculators in yen. And he just like, yeah, see you next year, right?
Yeah, it's interesting.
They're all chilling, actually, right? All of the Bank of Japan members are. Well, we haven't specifically heard from Ueda, but all the others are really sending us to January, March next year, right?
Yeah, yeah. They're definitely all coming out one after the other. Probably we haven't heard from as many as we have recently over the last year or so. They all seem to be coming out day after day, and it's a bit of a surprise that no one in the government or the MOF has followed up on those comments yesterday. You know, usually if they're that strong and that high level of jawboning, we get them every day. And it's just a bit of a surprise to come in this morning and find out we haven't had a peep out of them after yesterday. So maybe they think the shock worked yesterday because dollar yen hasn't gone much higher. But yeah, usually it's incessant. When they want a jawbone, we'll hear about it every day. Suzuki, Kanda. They trot them all out, but yeah, just triggered something in my mind to say that we hadn't heard anything from those guys this morning, but we shall see. Maybe they're all in the bar. Moving over to the RBA, and Lowe was out saying that the recent focus is the risk of wages and profits running ahead of rates, consistent with a return to the inflation target. And saying that if this risk materialised, and sorry, switch the old squawk off. Oh no, I've lost my place. Where am I? Come back. Yeah. So you were saying if this risk materialised and inflation became sticky, it would require tighter monetary policy. So leading the conditions as to when the RBA could hike again. Might all be a moot point, seeing as he's off and Bullock will be taking over anyway. The Riksbank doesn't look like it's in a good position regarding its currency. Deputy Governor Floden saying the krona is clearly undervalued versus fundamentals. And if we find tools to boost the Swedish krona, we are willing to use them, which sort of tells everyone that they've got no tools at the moment, which gives everyone the chance to spank it more. Riksbank Steden says we will do what is necessary to bring down inflation within a reasonable time frame. The Riksbank is one of the banks coming in the big week of the 20th, 22nd, 21st. They're announcing then as well. What are you making of these guys? They keep telling the market they're helpless, Kay.
Exactly, because he added that they could intervene, but he did that straight away, that it may be counterproductive and not long lasting. I mean, I've been looking at the Stocky. I haven't looked at it for a long time. I've been looking at it. I've seen some research, some strats saying that they expect Stocky to go much higher. But then if you look at the Norwegian krona, that hasn't really benefited that much either from these higher oil energy prices. So it's a tough call. I mean, if you go back to it's hanging at lofty levels but not coming off, and having a central bank which looks a bit helpless is not really helping the Stocky's cause. I trust there's going to be more sellers if at any time in the next weeks or so Stocky would regain a little bit of strength. That I think we're going to find sellers again. The problem for now is that well, still since the pandemic as well, but that Stocky is a bit of a proxy for the euro, because the eurozone is their biggest trade partner. It's a bit like the Aussie and China. We can compare, but actually Swedish krona is possibly even more linked to the EU than Aussie to the Chinese yuan. So there's not a lot of good happening, because we've seen the slowdown, especially in Germany, in Europe, and that is also weighing on the Swedish krona. So for the time being, I wouldn't go blindly sell Norwegian krona, but I wouldn't Swedish krona, sorry, but I wouldn't be surprised if this thing weakens further in the coming weeks or months. You know, I don't know at what speed, but I'm looking at it. You know, if you look at those daily around 1175, 1160, there looks to be a bit of let's call it rather 60-70, right? There seems to be a bit of decent enough support coming in to have a look at it. But will it even get down there is another affair. Yeah, if you look at it, it's really weak, right? It is very weak, the Swedish krona.
I wonder how far can they let it go without it, you know, starting to become a problem that might force their hand. And
well, I mean, it's an open question. Will they panic when it hits 12 and then they intervene just once to see what's going on? But again, I mean, in current situation and their current economic situation, and I don't see where this is going to, apart from the short-term market, where this is going to tell the market, yeah, we have turned the corner, you know?
Yeah, it's important to remember when you're talking about potential interventions and whatnot, which side a central bank is on. You know, if they're intervening against a weaker currency, they're on the wrong side, because they have to use reserves effectively to buy their own currency, rather than if you're selling your own currency, you can print as much as you want to sell. It's unlimited. But if you are fighting a weak currency, you're limited by your reserves, which then produces a problem, because if you don't have big reserves, then you're in trouble. And just to look at that as well, here we have Japan's foreign reserves, $1.25 billion or trillion, sorry.
Really?
So, you know, big numbers. It's down a bit, so this is probably just a bit of tinkering around, but they have got a big war chest with which to intervene with. That's why they don't mind knocking it for 500 pips, letting it run again, hitting it again, and then hitting it again if need be. So it's all about the war chest you've got, as much about the actions you take. And when when it comes to Japan, they've got plenty in the bank. Right, moving on, the great rate cut cycle has begun. The Polish central bank cut by a surprise 75 basis points yesterday. Were expected to only cut by 25 basis points, pretty much a year to the day where they got their rates to a peak of 6.75%, and now they're down at 6%. So just maybe the start of the snowball rolling down the hill in terms of rate cuts. But obviously Poland are out a bit on their own in terms of monetary policy and their economy, but still nevertheless a few fin twitters marking that as the start of the rate cut cycle to come from the majors. Over to the UK. UK house prices are taking a bit of a beating, down 1.9% on the month. I'm not sure if this shows up yet. There we go. 1.9% on the month, down 4.6% year on year. This is the fastest rate of slowing prices since 2009, say the Halifax. So rate hikes biting into finances and obviously house prices as well. For the Bank of England, they've had one of their surveys out, their decision makers panel survey, which is UK businesses. They've seen 1 year CPI coming down to 4.8% expected versus 5.4% in the July survey. So 6 pips off CPI forecasts or expectations for businesses, which is good news for the Bank of England in terms of expectations, but that number is still running pretty hot at 4.8%. We had Bailey and some of his crew at Treasury Select Committee hearing on the last monetary policy report. Bailey said that many indicators are signalling a fall in inflation, which will be quite marked. MPC members don't know how they're going to vote in September. Then he gave us a bit of a heads up, a bit of arse covering, you could call it, saying that possible that inflation ticks up in the next release, and that a tick up would not change our expectations for a downward path. So maybe, as I said, a bit of front running there, a potential upside surprise to the next inflation data. Says we are no longer in a phase where it was clear that rates needed to rise. We are now data driven as policy is restrictive. We are much nearer the peak of rates, but not saying we are at the peak. So as usual, is reluctant hiking self coming out there saying that we likely possibly are at the peak, but we're not going to close the door. BOE's Dingler was on the panel as well. She was far more dovish, saying that policy is already sufficiently restrictive. Further tightening poses a serious risk to growth. Domestic activity is weak and there's a risk of over tightening. So I guess we know where her vote's going to continue to be parked, on the unchanged side, when we get those in a couple of weeks' time. Germany, the woe continues from those guys. Industrial production looking very iffy, down 0.8% month on month, worse than expected. Year on year, down 2.25%. So nothing going too well over there in Germany. I think I saw a headline as well, IFO, one of the institutes over there, seeing a contraction of 0.4% for German GDP. So if there's one country that likely to head into recession, it's going to be those guys. Eurozone GDP, the final numbers were out, and a bit of a oops moment for those guys as well, or for the Eurozone as a whole. The flash number 0.3 was expected. It dropped to 0.1. Year on year, also a pip worse at 0.5%. So circling the recession line as well in the second quarter. Q1, as you can see there, was flat. So this is what's been expected this year, you know, growth bumping along that zero line, maybe a little bit above, maybe a little bit below. You've got to remember, if we get into technical or numerical recessions, it doesn't mean it's all doom and gloom. You know, just moving minus 0.1, 0.2% doesn't mean that the world's falling apart. It just obviously means that growth is slowing, but it's only if we start to see, you know, big drops in activity, real collapses in the data and real downturns, that's when we need to worry. But even ECB won't be too concerned if growth, you know, falls below the 0 number by a small margin. Over to the ECB bus, and Casimir, Kestrel Casimir, one of the hawks, said a September hike is preferable to later increases. Then said the alternative is to hike October or December. So keeping it very open. August inflation shows it's too early to declare victory. Again, that line on declaring victory. This is my thinking that a lot of the market is underestimating a September hike from the Fed and the ECB due to talk on inflation. ECB's Visco says interest rates have gone where they were supposed to go. We're seeing a slowdown in core inflation. Once rates reach the peak, monetary conditions in the Eurozone should remain tight enough. That comment, you could sense an angle that he sees another hike to come, or hikes, depending on his viewpoint. The OECD weighing in as well, saying that the ECB should keep raising rates as long as needed. Right, over to the good old US of A, and we'll just take a nudge back to the data yesterday. First data was the services PMI, the final number there, coming in a little bit softer as well, losing 5 ticks down to 50.5 from the flash 51, confirming the drop from 52.3. So the market sensing similar theme to the rest of Europe. But then we got the ISM, which went completely the other way. Now, I mentioned this yesterday on the show that there were some in the market who were underplaying this data as a potential market mover. We did indeed get some big changes to expectations. The headline number was expected to drop to 52.5, came in higher, 54.5. New orders were up a good chunk. Employment up 4 big figures to 54.7. Activity overall rising as well. Prices paid another jump, 58.9. So all this data was significant, in my opinion, for going into the Fed pot. Again, these prices go in higher in this metric as well. But overall, employment looking strong, activity looking strong in the bigger service sector, and as I say, prices going up. So that it's all more soft landing data for the Fed. Ali asks or says that Fed members are still signaling to us that US economy will slow in future, and that will be, or will that be the start of a US dollar downtrend? Well, at the moment, you've got to say that the data isn't suggesting that the US economy is going to enter a significant downturn, at least. But all Fed members, and you have to listen to what they say, all Fed members have been indicating that growth could slow, but there's not many that are saying that they're going to hit a recession or it's going to slow enough to be a significant problem. So in that scenario, you know, to see a big dollar turn, you're going to need to see this sort of data collapsing and producing numbers, the likes of which we're seeing in the Eurozone. So as for a dollar downtrend, it's not there at the moment. Dollar's looking very strong still. If you look at the data divergence between the countries, it's all favouring the US at the moment. So until that turns, the dollar is going to be on the front foot. So yeah, weak data is going to take it, but then is it going to, if we do see weak data, is it going to be as weak as the rest? Because even if it's not, the dollar's still going to be supported. So you've got to look at who's doing the worst to gauge who's going to have the best currency. The Eurozone's doing worse, the US is doing okay. Then obviously euro dollar's on its way down. That's the way you got to look at it. Right, so coming across to the Fed heads, Bloomberg with a piece saying that the Fed could double its economic growth forecast after all this strong US data. And that the lack of any weakness in the data, or large weakness in the data, may lead to fewer rate cuts being penciled in for 2024. This meeting, I think, Kay, is a projections meeting, isn't it? So we're going to get all the updated dots and stuff.
Which one, mate?
Is this meeting a projections meeting? I need to check it actually.
No, but which central bank?
Fed, sorry, Fed.
Oh, that's a good question. Yeah, September, I guess so. Huh?
Yeah, I can't remember.
September, I guess so. Yeah.
Yeah, I'll have to have a look at it. But if it is, then obviously the Duts, we need to keep an eye on to see how that affects the higher for longer narrative. But we'll check that out. We've got a long way to go before that. Fed's Collins said the Fed needs patient and careful, deliberate policy approach, can proceed cautiously on future rate hikes. Said we're not there yet on containing inflation. Could be very close to or at an interest rate peak, and still expect some economic slowdown in the coming months. So, yeah.
By the way, yes. Every 3 months. The last one is was in June. So yes, we have projections.
Cool. Okay, that answers that one. So she's Collins. She's keeping the mind that they're not declaring victory on inflation just yet, and as just mentioned, expect some economic slowdown in the coming months, but nothing that anyone should get worried about. Now, the Fed issued their beige book, which is sort of like a report from all the Fed districts on activity and an overview of what's going on. And some interesting lines in there that I've picked out. On the overall economic activity, it said that contacts from a lot of districts indicated economic growth was modest during July and August, and that consumer spending on tourism was stronger than expected, but other retail spending continued to slow, especially on non-essential items. Some districts also highlighted reports suggesting that consumers may have exhausted their savings and are relying more on borrowing to support spending. Now that could be significant if it plays out. Hence, we will need to see borrowing numbers like consumer credit data and obviously retail sales to see if there's a bit of a switch. The consumer turning negative is something that will potentially lead to a bigger slowdown than what might be predicted. So those are the sort of numbers we need to keep a look at. On labour markets, they said jobs growth was subdued across the nation, and although hiring slowed, most districts indicated imbalances persisted in the labour market as the availability of skilled workers and number of applicants remained constrained. So that indicates that the markets are still tight and that a lack of skilled workers is still an issue. And the number of people coming into the market was constrained. So that again might be changing, as we saw with the participation rate rising at the last NFP. And on prices / inflation, most districts reported price growth slowed overall, and it decelerated faster in manufacturing and the consumer goods sectors. However, some said that they highlighted sharp increases in property insurance costs during the past few months. Contacts in several districts indicated that input price growth slowed less than selling prices. So a bit of a margin squeeze there, that prices aren't coming down as quickly for input as they are for selling prices. So again, that puts a bit of a squeeze in margins because it means that people selling stuff aren't willing to put prices up as fast. So there's little signs still in all the data and these sort of surveys that there are some issues bubbling away. It's just a question of how bad do they get, if they get bad at all, and then we have to judge things and price it all into the central banks, the Fed, this one in this case. Lastly, Bank of Canada, they left rates unchanged as widely expected at 5%, doing their usual fence sitting, walk in the middle of the road, staying cautious on just about everything. The one line that did strike a hawkish slant for me is that they said they were concerned about CPI, and that if it remained sticky, they would be prepared to hike again. So one of the questions I wanted answered, or we wanted answered, was what were central banks going to concentrate on going into the latter part of the year? Would it be growth? Would it be inflation? And this gives us a bit of a clear indication that inflation is going to remain the main point in terms of monetary policy. Whew, that's that done. Okay, got anything you want to add to all that, Not?
No, I think you pretty much covered everything. I just wanted to add regarding the beige book that I'm old enough to remember when that thing was moving markets, and I'm actually relatively surprised that it didn't even move the markets for a peep, although no red flags, but we are seeing those kind of signs that things may come to, let's say, a slowdown, that it's closer than we were before. I guess if we are going to look for signs, and Ali was talking about that and asking the questions, those may be the things that is going to less surprise you in the future if those data start to come in a bit weaker. It may not create a dollar turnaround, but it may put people in alert and weigh a little bit on yields. But it's going to be the same everywhere, because we see in Europe that things are not going the right way. We have seen yesterday, for instance, in Japan, that the consumer is not buying into the revival or yet, and we see many indications, for instance, in China, that things are not going well. So it may not be creating the dollar turnaround, because if everybody goes down, actually it may support the dollar, because people want some safe haven somewhere, where it may weigh is on crosses like yen crosses also, or Swiss crosses. No, so that was about the beige book. No, for the rest, mate, you've covered everything. Yeah, it's perhaps okay. The Goldilocks scenario, if you look at globally with those numbers coming out, the Goldilocks scenario is still there, but then we have yields moving higher, equities responding to it finally. Well, S&P at least is down about 1.5% or so from the day before yesterday, and the dollar is let's call it supported, but versus stuff like the euro, which is to me a bit of the weaker link right now, it's not breaking. So we'll talk about those price action. It's a bit bizarre. Yeah, I see you're on the euro dollar now. To me, it's a little bit of a bizarre situation, because 107 is nowhere near a technical level. It is not. I mean, I don't know what you've got there, but I don't think it's a technical level at all. There's something strange here, because it looks to me like the market would like to sell it, but there's somebody on the bid there, and we can only guess, and we won't know. If it's a corporate, we won't know for long. If it's perhaps some of the dollar longs saying like, okay, with the warning that we saw from the MOF in Japan, why don't we just take some chips off the table? We see the commodity currencies stabilize as well. If you look at the Aussie, the Kiwi, the CAD, for instance, Norwegian kroner, it's all like very stable. Either we're waiting for the next leg to tell us where we go, or somebody is trying to buy a few euros or sell a few dollars, or just take profits. It just happens in markets without too much of a reason either. But it's quite notable, I'd say, that we are not even going below 107. Or just the last option, and I don't know whether there's any rumors or so, is that there could be some barriers at 107 in the euro dollar, because have we traded below? I don't think so, right?
No, we haven't. No.
So that may be the last option, that there is a bit of barrier defense as well, but then it's going to be a temporary battle, I reckon. But yeah, it's a bit typical that we are holding so easily, actually.
It's one. You say it's not a technical level. It's not it's not a fib or anything like that. But it is one of those levels that when you've been away for a while, it's had historical, action around it. All the way through, particularly latter part of that last year and through this year. It's just been one of those funny numbers that just always has a bit like the 105 as well. That just has a saying things, and like you say, there's a reason why it's not going below. Who knows what that is? But all you can do is trade it. You either go long off it or you wait for it to break. I'm eyeing a potential break because the bounces at the moment are pretty weak off of the level. So like Kay says, are we waiting for another reason to take it lower? So the more times we hit it and bounce weekly, the more inclined I'm to drop a couple of sell stops in below the level, maybe catch that break if it happens down to somewhere down to the recent low or the last lows that we had over there.
If I can just add one more thing to that, there must be something somewhere going on there, I think, because if you look at the crosses, barring euro sterling, because that's a sterling problem, they are not really going higher. You remember we had this whole period where the euro crosses were keeping up the euro dollar because people were buying the ECB going longer and started later, but then catching up on the rest of the central banks, and that held those euro crosses up. But if you look at the last couple of sessions, euro crosses have not really been doing great. If you look at Euro-Aussie, for instance, it's a bit lower than where we traded it in the 168s and stuff. So that's not the reason. So I think anyway, from kind of experience that I have, and I'm running a short already in the euro dollar, but it's something that makes the bulls and the bears equally uncomfortable right here at this level. Short term, exactly. Short term, that is short term.
And just going back to Ali, asking my thoughts on US dollar reversal time charts that I'm planning to take because nothing goes in one direction. I love long-term trading. I love trying to find the trends and find the moves. But right now I'm very, I wouldn't say neutral. I understand what is going to happen, that we're going to be playing the rate cut game. But trying to pick which horse to bet on, i.e. who's going to be the weakest, is a bit difficult. I still favour that the pound would suffer more normally, as it does often do. Even in these days, the pound is getting whacked more than euro dollar is. That's natural. So I favour being short quids via long euro sterling, so I'm happy to do that and sit on that for a longer term trade. But as for the dollar, and you're long and you want to know what's going to tip you out, well, you got to add up the reasons for why currency might be strong. It's strong because the data is strong. It can also remain strong even if the data weakens, because that weakening won't be as weak as everyone else. So it's still another tailwind for the dollar. So it's going to really take a collapse in the data, the US data, to even think about bringing a reversal. But as we said, even if it does collapse, is it still going to be as bad as everywhere else? So for the moment, the trend is with the dollar, and the reasons why the trend is with the dollar is sound. Now, if you want to protect yourself against that, then the obvious way to do it is via stops. But if you're trading the dollar to be strong for a long time, you've got to be trading your plan to be in dollars a long time. You can't be trading your long dollars with 20 pip stops. You want to be looking for the big trend move. So dollar yen to continue, euro dollar to continue lower, cable to continue lower, those sort of things. And what you want to be looking at is maybe building up a bigger position. So, you can get in your trade, take a bit off, add a bit more on the dips, slowly take a bit more off, but, increase that core position. So if you're going to run a trend, if you think that the dollar is going to be great for the next 6 months, then you want to build into a position and look to profit from that thinking. And your risk is your stops. And as I say, you can build it in. You need to give yourself a bit of room for trades like that if you're trading longer term. You can't trade longer term with 20, 30 pip stops. That just doesn't work. You can go with the trend and just keep knocking little bits off. But our way of trading here is you want to try and milk these moves for as much as possible. Right, so as Kay was mentioning, so obviously the pound is getting a whack. Look where we are, Kay. We're nearly down at our magic 124.50 level.
Yeah, we are right. It's crazy because we've had these and must have been because it was summer or so. But we had this Bailey when he was speaking the last 2 or 3 times. His pound did not go down because it had some better resilience than other currencies. But he's hit it hard yesterday, and I don't know. I mean, the market should not be trading on Dingra because I really. Has she been put at the Bank of England for a purpose, just to have somebody saying that rates should be at 0 and that she will never hike? Or I don't know why she's actually there. But yesterday he was very counterproductive for the sterling again, and then at the same time we had those housing data coming out left, right, and center, which did not help the sterling either. It's seen the Halifax house price again coming off earlier today. It's dangerous, right? For the time, cable has kind of broken some range that we were in there. Yeah, you were showing that we're on the cable there. I think it's around. Well, it started to break around 126, then 125.5. It's undeniably trading weak now. The issue, I mean, that we have with Bailey is that he just he's already, you see the picture weakening a bit, but then the inflation staying stubborn. So the market is ready for the Bank of England to go a little bit further, but then he comes like, no, we may be very close to the peak and it's going to be a mess in the UK. I mean, it's incredible how this guy has hurt the sterling over time, and I reckon now the market is starting to do the opposite with the sterling as it's doing with the dollar. Well, with the dollar, the market is pricing in higher for longer. We have the US Treasury increasing their bond offerings, and the numbers are holding up a little bit better than elsewhere. And then on the sterling now, the market, after if you got a Bank of England, a bit like the Bank of Japan, who says they will only raise interest rate in 2024, and if you have a Bank of England who says, you know what, I mean, it's a bit of a mess over here, and what do you think the market is going to do now? Then nobody's going to buy sterling, and we see already UK rates starting to come off. So that's I think it's a weak picture all of a sudden now for the sterling, at least a lot weaker than it was for 2 or 3 months prior.
Yeah, because we had that move up pretty much over the summer, but good, right? even longer than that, if you take it from the Liz Truss troubles, it's been on a hell of a run. But cable's cable. It's the one where you blink and you're off 200 pips. And you've done 30 pips in euro dollar. That's just the nature of the beast. It's not as liquid as it used to be in the old days. You always have to take that into consideration when you're trading it. I might have a little nibble down here actually, just on that this 124.50. I'm just going to keep an eye on it, see if I can get close to it. Got the 200 DMA coming in just below as well. What's that at?
Where's that?
24.
Where's that?
124.24, that DMA.
Okay.
So yeah, we got that 124.50, the DMA. I might have a little nibble long down here.
The thing is with sterling, I mean, I found it like really since the beginning of my career, actually, which is 4 decades bloody hell ago. I always find sterling, the market trades sterling. Sterling is an emotional currency as well. It can do well just because people feel good about things, feel positive. I always compare it like, okay, people can say risk on, risk off, and it has been trading risk on, risk off as well historically. But I always found sterling, for some reason, to be a bit of a emotional currency. You either feel very good about the sterling or you feel crap about it, and it immediately reflects in the currency.
Yeah, oh, very much so. You're absolutely right. You know, you never hear many people who are neutral on the pound. They're either heavily bearish or heavily bullish. There's never any middle ground. But anyway, I'm having a little nibble long at 65. I'll have a little bit more at into that 50s if seen, and I'll see how that daily moving average done. So I'm in a bit of long cable now. Don't ask me why, but you got to trade the level sometimes. And that 124, as you can see, was a real, or 124.5 was a real decent level, on and off as well through that second quarter of the year, if you like, here as well. So yeah, give it a go, see what happens. Not going to lose any sleep over it. But coming back to what the dollar's doing generally, and I did show this this morning as well in our chat room. We've got a little bit of a pause going on, you know, a bit of a 2-day lows, 2-day bottom, whatever you want to call it, in a lot of dollar pairs. Aussie dollars one, Kiwi dollars another, you know, just similar patterns where we're not going down anymore. But what's striking me is that the bounces are very weak. We're not making any inroads. We're not breaking higher on the bounces. We're not making new highs above old highs. So we are looking like tentative, if you like. We're still looking bearish, using the Kiwi as one example, but we are finding a bit of a bottom. So you could get a similar situation to what we got, you know, the latter part of August, you know, where we nudged along, finding lows here and there. Then we had a bit of a bounce. But if we can't hold those bounces, then it's ready to do a bit more and come lower. And now we're setting up a similar sort of pattern. So yeah, we could get a bounce back up to the mid 59s. But if we don't get any higher than that, likely is we're going to come a bit lower as well. That's if we don't break low initially. So when you're looking at catching the knives, you've got to look at these small ranges, intraday ranges that develop. You know, call it 59, 58, 60s is your lows, 59s is your level above. You know, and you really want to look to maybe go with a break of either side. If you want to mess around trading the range in the middle, feel free, keep it tight. But it's small steps. Even if we do break above 59, you know, that's a small step compared to what we've done over the last few weeks. But small steps can lead to big steps. But yeah, the dollar's not doing an awful lot this morning. Dollar yen had managed to nick out a new high, which ordinarily would be significant because it shows it's still willing to push up. You know, even a few pips above the prior high still shows you that people want to push it. But the rejection, again, maybe there's some nerves in there now, given Candace's comments, which, again, I'm surprised they didn't follow up today as well. But we're not dipping too far, again. So really, if you have to set boundaries here, you're probably looking 147, 148. Make your judgment based on which way we go from those two. We could just mooch around in the middle, but if we break 148, then we're probably off and running again, another leg up. If we're through 147, maybe we've seen a bit of a stronger top being put in, and we get a further drop down, maybe 146s, that sort of thing. Kate, did you want to grab a couple of charts?
Yes, sir. Yes, I will. Not going to show too much today because not a lot has changed, right? If we look at yesterday's move. Well, first of all, I just wanted to repeat, I found those ISM service numbers pretty strong over the whole line. And then if you look at, as Ryan already mentioned, quick new high, but then it came back down, the dollar yen, and euro dollar did relatively the same. So on the dollar yen, if you look at it technically, or if you look at charts, it looks a bit cleaner than the euro dollar, because we are still going up, right? And for the time being, I'd say your first support is going to be bang on 147. And then below there, it's going to be around those prior tops again, call it 55, 65. If it goes down naturally below that level, then there is something changing. But of course, we can't forget about what the Canada specifically said yesterday about its speculation. So you always have to be very careful what interventions may mean. But for as long as this holds, and this 146.5 as well, I think we are still on our way to high 148s, 149s, and then which will be the gateway to 150, of course. Very big psychological level, also a bit of an extension there. Yeah, I mean, for the rest, not a lot is changing in the global yen picture. If we take away those intervention threats, it's still. Yeah.
Quick question.
Yeah.
What if you know, what do they regard as speculation then? You know, because you could obviously one-sided move. So if it was all yen weakening at once and everyone else was doing nothing, then you could say it's a bit of speculation. But this is more. It's a general dollar move, which is dragging up. You know, the divergence trade is still on. What do they look at anything specific to note speculation?
They see the volumes and they see the how shall I say, not the asset but the client class. They see volumes and they are very well informed by their agent banks. It's just that, mate. I mean, they know who's buying and who's selling, basically.
Yeah.
And if they see too much of non-corporates, non-sovereigns, non-Japanese insurers, Japanese trust banks, if they see a lot, if they've got these numbers and then they know kind of what the usual volumes are, if they see bigger volumes, they can deduct it from there as well, you know. I mean, yeah, they just know. Let's put it that way. I've been working for an agent bank of the Bank of Japan, and they see all the data. Basically, they don't see the names because that's confidential, but they see all the data, and they will know whether it's like real money or whether it's speculation.
Yeah. When you're in the business, you know, even if you don't see a name, you know the patterns, and you learn that as traders. I did the same before. Yeah.
They see the volumes.
Yeah.
It's as simple as that, really. You know, when there's money involved, people want to know what's going on, and especially if you are a supranational or the central bank, you want to know who is doing what in your currency.
Yeah. Thanks, mate.
Okay, so yeah, so the overall picture, nothing changes. I still think based on what the Bank of Japan bots are telling us, the numbers being a bit ish, you know, a bit changing in Japan, and then with the dollar just being strong against most of the currencies now, I don't see a reason for this to start to reverse. Unless the rest of the world starts to collapse around it, then it's a different story. Because with higher yields elsewhere, it also increases volatility, and we have seen in the yen this volatility, right? We only on the 1st of September we were trading 144.5 with 3 big figures higher. It's in less than a week, you know. It's still relatively volatile compared to what we've seen in yen in the good old days. Dollar yen could move 10-15 points in a day, and that's it. Now with higher yields globally in the market, there is always a little bit higher volatility. Okay, euro dollar, Ryan already said it. I think we're turning around this zone here. Must be something going on around 107. But to me, it's still oriented to the downside right now, and I wouldn't be surprised before the week is over that we're at least going to test this 106.35 prior low, which is going to be then the gateway to what people look at being a big level around give and take 105. That's still my preferred side, but it may just be that the trade is getting a bit crowded right now. That's possible as well. So it could be a slow grind, and why not just grinding slowly along this trend line. You know, we have seen that in the past as well. So that's my view here. If we start to move, 107. Sorry, 107.30 is too close. But if you look for a reversal or saying like, oh, I may be wrong on my shorts, keep an eye on this zone. I say 107.75, 107.90. If it starts to go back above there, then I think we are at least much more neutral. Or it may be that the dollar is starting to weaken a little bit, and I guess above 107, call it, yeah, 3/4, 108, the figure. That's going to be your zone, and that maybe replies to Ali as well. I'm not saying for the long term, but I'm saying for at least in the shorter term. If it starts to get back above 107, 3/4, 108, the figure, I say be careful. Okay, that's what I think. And then okay, Ryan already showed the sterling. You did show the Aussie and the Kiwi as well. They are very rangy right now. Kiwi is looking a little better than the Aussie, but we are below successive like break zone still. So for as long as Ryan already said, 59, 59.25, I'd say. As long as you're below there, it's still looking negative, but we have to respect this little sideways move right now. Aussie as well, I think 64, pretty decent trend line broken here, where the main one was around 65 and a half. We've tried this zone, retried the zone, and then it went down. I think your nearest one, day trading one, is 64 to 63.60. Start to get below 63.30, 40. That's going to be very negative again. But for the time being, is it justified? Probably with the dollar, but it looks like the market wants to take a breather. So don't go and do anything silly in between. Okay, I need to speak a little bit about the mix, okay? Because we've had this scare on the on Banxico, on this currency hedge, and we've seen dollar mix starting to ramp higher, and I'll show the euro mix as well. But to me, and it's 18, 17.90, 18. This is the magic level. I'm not even sure, but it's going to be a big level to watch. And look, the 200 DMA is also lying at 18.02. That is your big zone. I think if and I've seen reports that some banks have already given up on their carry trades in the mix because they got a bit scared and stuff. But I think for as long as we are below there, the overall trend that you see here hasn't changed. We're still in between levels, right? So yes, there's been a scare. Yes, there's going to be volume a bit negative mix, but when is it? I think it still can get absorbed unless we're starting to see Mexican data turn around. And actually, I think today, and why doesn't my calendar show this again? I think I must have done something with my filters. Yeah, just give me just 1 sec. I think today we have the Mexican CPI, if I'm not mistaken. Yeah, we have the Mexican August CPI coming out. So keep an eye on that one. That could be the next trigger. If it holds up, the whole scare in the mix may eventually be over. But we are now back on those prior break levels, 1740, 1747. Watch that zone on a close tonight, okay? 1740, 1747. Top side, 18. That's your magic level, okay? And we need to look at it because I'm not convinced that this move is going to hold this move higher. Similarly on the euro mix, I warned about this possible retracement. I finally gave in to the sirens and started to slowly leg into a little bit. I'm going to trade this actively. We've had already this pretty sharp move lower today, so I've already taken a little bit off. But I'm looking to build up a short again, and I will put a stop above this prior high But if you look at the longer term, still firmly in a downward trend. And I'm going to stop it here, Ryan, for today.
Thank you very much, mate. Yeah, I think we'll call that a session. Thank you, everybody, for coming to the Flow Show as always. Don't forget to check us out in our chat room if you're not part of the crew already, the community. You can see us doing this all day, every day. Have a good rest of your day. Take it easy, watch those levels. And thanks very much to Kate, and we will see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.